Hey, welcome back to Blockchain Basics. Today we're going to reevaluate the risk of the US economy falling into a recession in the coming months. Our thesis, going all the way back to February of last year, has been that a decade of 0% interest rates and massive government stimulus has led to the consumer price inflation which we've seen over the last 2 years, which in turn has forced the Fed to raise short-term interest rates, thus inverting the yield curve, which historically has been the best predictor of a recession. And yet, here we are more than a year later, and unemployment has been at all-time lows, GDP has remained mostly positive, and the stock market is approaching new all-time highs. So while nearly everyone was forecasting a recession last year, the Fed included, many analysts have now discounted the risk of the economy entering into a recession, which might lead you to wonder, has the recession been canceled? Of course, no one knows with any certainty what's going to happen. But in these next few minutes, I'm going to make the argument that the recession is still very likely, and to understand why, we need to start with the yield curve. If you're interested in a more thorough explanation of the yield curve, I'll link to this CNBC video from December of 2019 titled How the Yield Curve Predicted Every Recession in the Last 50 Years. But for now, here's what you need to know. The yield curve tracks the interest rate you earn by lending your money to the government for varying lengths of time. In a healthy free market economy, the longer the term of the loan, the higher the interest rate, which creates a yield curve that looks like this. When the Federal Reserve raises interest rates, they're essentially raising rates at the short end of the yield curve. Over the past year, the Fed raised rates from 0% all the way up to 5.5%, so that now short-term rates are higher than long-term rates. In other words, the yield curve is inverted. But to understand why this matters, and why the yield curve is such a good predictor of recessions, it's helpful to know a little bit about the Austrian business cycle theory. The Austrian business cycle theory, introduced by the economist Ludwig von Mises and later developed by Nobel laureate Friedrich Hayek, suggests that the economic cycle of booms and busts are primarily a result of governments interfering with the monetary system. And how do governments interfere with the monetary system? Through the distortion of interest rates. Governments are incentivized to keep rates lower than they otherwise would be under free market conditions because in the short term, low rates increase economic growth and consumer spending. Lower rates also make it cheaper for the government to borrow money, meaning they can spend more on big infrastructure projects and social programs without having to increase taxes. But all of this comes at a cost. See, when a person or a business takes out a loan, new dollars are created that didn't exist before. When they then pay that loan back, those dollars disappear. But when interest rates are very low, old loans can be rolled over into new loans, creating a debt bubble. As more debt piles up in the system, there's now a greater supply of dollars competing for goods and services, and prices begin to rise. To keep prices from rising too quickly, the central bank is then forced to raise interest rates, which makes it harder and more expensive for borrowers to access credit. This leads individuals to cut back on their spending, it leads businesses to pause new investments and lay off workers, and businesses that were already struggling are forced into bankruptcy. All of these factors create a deflationary recession. The central bank wins the war against inflation, but at the cost of economic growth. At this point in the cycle, as the economy starts to fall apart, the central bank steps in again and lowers rates, starting a new business cycle. The yield curve is just showing us which phase of the cycle we are currently in. We can visualize when the yield curve inverts by choosing two time frames like the 3-month and the 10-year and looking at the spread or the difference in interest rates between them. Every time the spread drops below 0, indicating that the yield curve is inverted, a recession follows shortly thereafter. When this CNBC video was made in 2019, the yield curve had just inverted again. But many economists and pundits thought that the economy still looked strong and that we would avoid a recession.
The yield curve inversion I would not read too much into.
There's no likelihood that the inversion of the yield curve that's occurring in this period, A, is similar to the ones that occurred in the prior period, or B, that it will lead to a recession.
Of course, in retrospect, we know that we did enter a recession in March of 2020. So what, did the yield curve predict that a pandemic was coming? Probably not. But the market was signaling weakness, and it was just a matter of time before something came along to push it over the edge. And this is exactly the place we find ourselves in today. In fact, the yield curve is more inverted today than at any other point in recent history. So, where's the recession? Well, if you look closely, you'll notice that it's upon the uninversion of the yield curve that we enter into a recession. Again, look at 2019. The yield curve inverted in March of 2019. The recession didn't happen until 11 months later, after the yield curve had already uninverted. How about the Great Recession? Again, the yield curve was signaling weakness as far back as early 2006. We didn't enter into a recession until a year and a half later, after the yield curve had already uninverted. Same thing happened during the dot-com crash. Okay, but who cares about the yield curve when the job market is so hot right now? Unemployment is at record lows. There's no way we can enter into a recession, right? Not so fast. Let's add the unemployment statistics to this chart. Look at that. We always have the lowest levels of unemployment right before we head into a recession. This is all part of the business cycle, and yet every time, people think that this time will be different. All right, now let's look at the stock market. Does this look like a stock market that is priced in a recession? We're up 30% in less than a year. Look at Bitcoin, up 100% from its lows. Could the market have already priced in a recession last year? Well, again, that would require that this time be different. In 7 out of the last 8 recessions, stocks bottomed during the recession. And in the one exception, which was the dot-com crash, stocks bottomed after the recession was over. And don't expect the Fed to jump in and lower rates at the first sign of weakness like they did in 2018 or even 2020. The Fed continues to say they will keep rates higher for longer. They would rather cause a recession than have a repeat of the 1970s when the Fed pivoted too quickly and inflation came back even worse than before. Okay, so are we starting to see any warning signs in the economy? If you're paying attention, yes. Used car wholesale prices are down 11%. Dealers can't sell EVs, even after massive price cuts. Commercial real estate prices are down too. Office buildings are down more than 25%. But look, apartments, industrial buildings, malls, self-storage, they're all down year over year. And the regional banks, who hold most of that debt, are sitting on these losses. Most of this is short-term debt. So what's going to happen as more and more of that debt needs to be refinanced in an environment with much higher interest rates and banks that are less willing to lend? Even the large banks that are not as affected by commercial real estate are sitting on mortgages and bonds that are paying 2-3% interest. I don't know if you've looked at savings rates, but Wells Fargo, for example, is offering 0.25% interest. That's because they're sitting on all of these assets that are paying 2 to 3% interest in an environment where a 3-month T-bill is paying 5.5%. So you better believe that deposits are going to continue to flow away from the banks into money market accounts, into T-bills, and lending is going to continue to tighten. But if all you focus on is, oh, the S&P is up 30%, my portfolio looks great, then as Warren Buffett says, you're going to be caught swimming naked when the tide finally goes out. By the way, that 30% gain on the S&P is entirely due to 7 tech companies. Remove those 7 from the index, and we would basically be flat for the year. And there's one more thing that's absolutely critical. Student loan payments are about to restart for 40 million borrowers. That's 40 million people with less money to spend in the economy. 40 million people who have lived the last 3 years without having to make a single payment, who thought they were going to get $10,000 in student loan forgiveness, who went out during the pandemic and took out more debt that are going to have to pay hundreds of dollars a month starting next month. And remember what happens when you pay off debt. More money is removed from the system. The business cycle can take a long time to play out. Yes, eventually the Fed will pivot and lower rates, but more likely than not, it will be too little, too late. That's not investment advice. I'm not a financial advisor, but thanks for watching. If you made it this far, please like and subscribe, and I'll see you in the next video.